Alright, Cap, I'm going to make this video for you, and I'm going to show you some things that I do when I start looking at the market. I'm going to use the dollar, the US dollar index, but what I'm going to teach you, it doesn't matter what market you're trading, because the concepts are all the same. Okay. Now I know you mentioned you liked the trade Forex, so let me show you how I have this set up for Forex when I do trade Forex. And you can do the same, or you can make a different decision based on what you want to do. However, each one of these, okay, let's start with the dollar index, okay? Each one of these currency pairs, the Euro dollar, New Zealand dollar, British pound dollar, the Aussie dollar, all these dollar pairs you see with the USD in the end of the currency pair, this is a pair. You have the Aussie dollar, USD, British pound, USD. When you see the USD in the back of the correlating pair, that means each one of these pairs, they're going to follow the dollar index. And the ones you see USD first and then another currency pair, they're going to follow it too, but typically in the opposite direction. So they call them correlating pairs. So what I do on a daily basis, I would go to a daily chart. I will highlight the high of that day. And I already have templates created for that. So if I went to a template, I can find the daily candle high. Then I'll also create a level here. And obviously, what is this called? Right. This would be the daily, what happened to it? The daily candle low. There. Now, in TradingView, I'm going to encourage you to lock that. How do you lock each one of these things you put on, each one of these tools you put on the chart? You go down to where you see a lock. That's going to lock it. Now, why do you do that? Well, you do that because if you start moving the chart around like this, and if you grab it accidentally, that would move. So I lock it. So at the beginning of the day, I find out where the candle high and where the candle low is. Then I move down to lower time frames. So I go down to the 4 hour. So now I see that candle low for the daily chart. This is that low of that day. And I'll fine tune that chart. Then what I do is I start reading the candles. Okay, this is a bearish engulfing. Typically, this is an area where price wants to return to, and it's an early warning sign that price is going to go lower, and it is pulling back before it goes lower. Now, where is this price going to go to? Now, I want you to look to the left. See this wick? These wicks are very, very important, Jay. These wicks let you know where the algorithm pushed price down into and stopped and reversed. Now, this is something that this wick low and that wick low, I also have a name for that, and I call it a relatively equal low. Why is that important? Where is that? Where is relatively equal low? Okay, so I don't have it here, so it's in my other platform. So let's go ahead and create this. Rel equal lows slash highs. Sometimes this is also going to be called resistance should it be resistance, or should I use it a break of structure? I'm contemplating on my definitions here, because you're going to see online people use a lot of different terminologies, but relative equal. So they're relatively equal lows and relatively equal highs. I'm going to change this red color to, let's see, let's change it to text, just make it black. Let's be consistent. And because, you know what, I'm going to do the line black as well. Let's do the line black as well. Have everything black, let's stay consistent. So this low and this low, they're not equal, but they're relatively equal. Once it breaks this particular low, that's going to be a market structure shift, a break of structure, or a change of character. You'll hear those terms used, and they pretty much mean the same thing, because it took out this low. Now I'm going to bring you over to the far left, and then I'm going to teach you something you probably haven't learned yet. But I'm going to make sure you get all the understanding possible that I know. You see this wick right here on the top of this upper closed candle, this green one? There's a wick right there. And there's another wick here on this down closed candle. Now the space between this wick's low, or high, this wick's high, and this wick's low, it's called a fair value gap. And I'm going to extend that all the way to the right. And I'm also going to make the center of it a little thicker. That middle line means something, okay? Now I'm going to lock this. Actually, let me do something else. I'm going to add what I'm calling this, and it's called a fair value gap. And we don't want that to be purple. We want that to be black. Dead smack in the middle. We're going to put it in the middle, center, and inside. So I just put it right there. This area's this wick's low to this wick's high. That area is called a fair value gap. And lock it. Now let me talk about the fair value gap here for a minute. What that is actually is a price. I'm going to do a different video on price delivery. But price didn't deliver sell side all the way to close this gap. Price shot up so fast, it pulled back. It didn't close that gap. And let me give you a better example. There's a gap between the delivery of price between these two wicks. When you start to learn how to read price, I want you to notice something, and this is very important. Here's another fair value gap. From this wick's low to this wick's high, that is a fair value gap. What that means is price moved too quickly, and it didn't deliver price. Like someone, here's an analogy. If you ever watched a race, a relay race, where there's running the 440 relays in track, there's 4 people, and they have a baton in their hand, and they're running their quarter, and they pass the baton to the person ahead of them. That person takes the baton, runs his quarter, he passes the baton to the next person. And then the last leg, that person, the third leg goes to the last leg, and he hands the baton to the next person. In price, it's the same way. Imagine this person right here being a track runner, and he's supposed to deliver to here. But guess what? It didn't. That gap was left. That baton was not handed off. Now let me show you what I'm talking about. If you look at price everywhere else, there's no gap in price. This candle delivered to that candle. This candle delivered to that candle. That candle stayed there. This created a doji. that delivered to that candle. There's a little gap right here, and they call that a value imbalance. You probably don't see this, but I'm going to show you this now. If I open up this chart right here, this little area was a value imbalance until this wick came up and delivered price. If this wick had not come up, that would be clearly a gap, and they call that a volume imbalance. Because the volume is this candle, it starts losing value, and it just wicks. And they call that a tail wick, and that's the wick. So, but if that wick had not appeared, this would have been open, and that would be, it's called a value imbalance. And here, price did deliver, it handed off, it went right back to the volume there. But you'll see times in price, especially in the morning sessions. That's why I like to trade the New York opening bell. Because typically, let's go to a 9 a.m. time. Let's go to 4 p.m. Today's Friday. So I'm going to have to go down to a 1 minute chart to show you this illustration. But I am going to go back to that other chart, so be patient. See, 9 o'clock in the morning, this is 9:30. 9:30, boom, 9:30 right there is when the market opens, right there. So I'm going to get this out the way, go here, and mark 9:30 in the morning. This is the dollar, so I take the NASDAQ, so this is a little different experience on this particular pair. But typically, in the morning, see that gap? It happened here. See that gap right there? Let's open it up. That gap, where's 9:30? 9:30. This gap, it created that gap. And it does it a lot. But I just trade one particular pair most of the time. But where's 9:30? 9:30. Where's that gap? See this gap right here, 9:30? This is what they call a new day opening gap. In trading, you'll see gaps a lot. I like the New York opens because it typically opens with a gap. And guess what? In the first hour, it typically closes that gap. And that's where you would enter here and you would ride it up to the next swing high. So that's why I like to trade the opening bell. And that's what my key core content is about in the beginning course. I have other strategies. One I just mentioned to you about the fair value gap. But that comes in the other lesson. So let's reset this chart. Okay, so now we have a gap here. They call that a fair value gap. Now this is a fair value gap that's bullish, meaning it's holding price up. And this is a fair value gap that's bearish. This should be a different color, so I'm going to change this color. I might have a bearish fair value. I have it in there already. Your first bearish fair value gap. Your first bearish fair value gap. The IV means inverted fair value gap. And I'll talk about that in a different lesson. Bearish first. And this would be the first presented fair value gap. Fair value gap. Now, I'm bringing the fair value gap to your attention because price typically returns to this area to retest it. And the 50% area is where you see these dotted lines. That's half of the whole signature of the fair value gap. If you put a Fibonacci there, it's the 50% line. Some people call that a mean threshold or a consequential culture. Either way, it's 50% of the fair value gap. And it's a lot of ways you can use that 50%. When you start, we'll talk about it in a different video. So what I've introduced to you so far is the fair value gap. The reason why that's really important because it leaves price without being delivered properly. And what the algorithm is going to do is going to come back and retest that area. Now, if it closes below the fair value gap, that then becomes an inverted fair value gap, like you see I have noted up here. The IVFVG means inverted fair value gap. Basically, price ran through it and stayed below it. That becomes a new resistance area. Some people would call it a supply zone. Some people may call it a support area. You see how price came down, but it didn't go to the 50%, and price jumped back away and pulled away from it? That became a fair value gap support. And guess what price went to? It went right back to another fair value gap. To here, to there. And guess where it went to? Just above the 50% of that fair value gap. And then price rejected and went back downwards. Now that's on the 4-hour time frame. However, depending on the time frame you want to trade, me personally, I don't trade the 4-hour time frame. You know why? Because that's practically all day for just 2 candles to make a move. And then another session will start. So I trade typically from 30 minutes to the 1 minute time frame. I want to be in and out of a trade quickly. I don't want to trade no more than 2 hours a day. Sometimes I get greedy, and that's where I make my mistakes, because I get too greedy. But now let's go back to how I set it up in the beginning. So when I first look at my charts, what do? I identify the high of the candle and the low of the candle, and I mark them out. So here's the candle low, here's the candle high, and then I start going down to lower time frames. Now, what am I looking for in lower time frames? Well, I'm looking for the ranges. Here's the high range, and this is called, I'm gonna use this body candle because this is a fakey wick. It's a fake out wick. I'm gonna use the body candle, and I'm going to label this buy side liquidity. I have a template for it. This is external buy side liquidity. So there's liquidity up here. Now what's liquidity? Liquidity is basically money. Okay. People who went short here, they put their stop losses above that. There's a stop loss above these 2 candle wicks. They call that liquidity. Now there's different forms of liquidity, and let me teach you 2 other forms of liquidity. Okay. So I'm going to use this tool right here, and I'm going to write liquidity area. Okay. The top of the wicks is the liquidity area. That's where the money is. That's where traders put their stop losses at. Or guess what? They also put their take profits at. Okay. Now, if I was in this trade and I were bullish, which means I'm thinking for price to go higher, coming off this double bottom, this is a double bottom, off this inside this fair value gap. Price is starting to move again away from the liquidity. There's liquidity. It tried to grab some liquidity from that area right there. All this area in this little zone, people have their stop losses there. They got stopped out, and the algorithm took their money, and now it wants to go higher. So you start to mark up your charts. Okay, you start to mark up your chart, and you start to see price change direction, right? In the course that I have you study, I'm having you to study something called the 3-bar reversal. That's the first thing I want to teach you. How does that work? Well, see this one candle? Let's open this up some. This is the first candle, bar 1. This is the second candle, 2. And this is the third candle. When you see a formation like that, that's an early warning sign that price may change. And what you can do, once you see price start this wick and this starts to go here, you can put a line on top of that candle. And let me do something right in the middle of this. you can place a limit order. Okay. Here, put your stop loss. I'm going to use the abbreviation SL. SL stands for stop loss. Below the lowest wick candle. Let me show you what that looks like. You put your limit order here, and your stop loss you'll put right here at the daily candle low. So get into a habit of marking up your charts. And what helped me to learn faster was me creating all these templates. So this would be, we call it sell side liquidity. AK, let me do it this way. Sell side liquidity. AK, KA, SSL. Okay. You should have a list in the course of all the terms that you hear me talk about. So go back to the course and find that document with all these different labels and names that I'm naming to you now if you haven't done that already. Okay, so now when you see this 3-bar reversal, you want to go to the top of that candle wick. You want to place a limit order here. And then you put your stop loss below the lowest wick candle. This is the lowest wick candle. That's where you put your stop loss. Now, like we and I talked about before, every trade is not 100%. Okay, but here's where you place your take profit target. So imagine you had your limit order here, price moved around, and you notice price was going here. Even if you missed it, it's fine. But when you see this candle form, you can mentally just put a limit order here. And if you don't get triggered in, you don't get triggered in. But the next thing you want to do is set your take profit target. Your take profit target, you should have up to 3. It's going to be the next swing high. This is really the next swing high right here. Because this high is higher than that high, and this high is lower than that high. This candle right, that's your take profit target 1. Here's your next swing high. This high is higher than that high. This high is lower than both of those 2 candles on the left and the right side. So this is a swing high. Here's another swing high. You should have an exercise in your workbook where you start to identify swing highs and swing lows. So this first swing high can be a take profit target. The second swing high would be take profit target 2. The third swing high is the take profit target 3. And if you really want to be risky, you can go towards this swing high. And it's a high probability trade. But it's best to get out quickly. Don't get greedy. Because price can reverse on you in an instant. So this is the lesson I want to dedicate to you today. I don't want to take up a whole lot of your time. But please comment on anything and everything that I write for you in the comments. So when I read your comments, I can create another video explaining and answering that particular questions that you have. And I'm sure others would have too. But Jay, I want you to learn how to trade. I want you to be a multi-millionaire. I want you to grow. I want you to be the best Jay you can be, your father. And I wish all the best for everybody in our family, bro. But everybody has their own passion, do their own thing. But this is easier than you think. It's just going to take you some time. Don't beat yourself up about it. Don't get frustrated about it, because you're not going to get this overnight. And there's a whole lot of other stuff I want to show you, but I want to roll it out to you a little bit at a time so you can digest piece by piece. But I encourage you to stay with it, because this can change your financial life, bro. Just imagine just working 2 hours in the morning, you made $1,000 before you went to work, or $2,000. And don't get greedy. That's been my problem. My goal is to have $1 million on my capital account by the end of this year. That's on my vision board. I want to stay focused on the end-of-day trading. I want to manage my risk. I want to spend time in prayer. I want to pay off my debt. I want to teach more people, and I want to teach them my opening bell strategy. That's the core first lesson that I want to teach everybody if they sign up. And that's really all you need, but I can teach you even more to give you a broader and a better understanding, like time and price. And you'll get to that if you see one of my videos, times and price, take a look at that. Please like, please share, please subscribe to the channel. Stay connected with me. You can communicate with me in schools. That's one of the best ways to communicate with me because I'm in and out of there. I try to go in there every day. Sometimes I'm up all night. Sometimes I don't even do an opening bell. I don't have anybody to talk to. So I create other videos, and I have those videos in my files. I have all these videos that I have not put on YouTube. Some of them are different issues, but all these videos here, bro, since February, I got recorded, all kind of stuff I haven't put on YouTube. Most of my stuff that I put on YouTube is in here, some rants and raves. Liquidity videos, that's on YouTube. I just, let me talk about that for a second. Hold on a second. Let's talk about liquidity again. Okay, you'll see this in the liquidity video too. You see, where you see all these wicks are, people put stop losses below those. When you see people talking about trend lines, these two, this whole line, this whole trend line, there's liquidity on that trend line too, because some people trade by trend lines. So if it breaks the trend line, they're going to either make a decision to enter the other direction or not. And here's a key tip. Write this down. Write this down, Jay. Write this down. Write this down. I want you to be just a bull trader. What does that mean? I only want you to buy the lows, like buy low here, and get out when it's high. Do not try to be a seller or go short. When you go short, you lose more money because they take a different variable out on shorts. Now, I'm going to train you how to do shorts as well because it's really the opposite of doing longs. But typically overall and over historically over the stock market, price has always gone up more than it has gone down. But you still can make money when it goes down. But that'll be a whole nother topic. For now, I want you to think about marking up your charts, how I start my day off with a daily candle high, daily candle low, and then what I start doing, I start walking down, see where price is. Is it closer to the high of that day, or is it closer to the low of that day? Those are the questions I start to ask myself. Now, on this particular dollar pair, you see price is going higher, and guess what it's going to target? Price is going to target, once it takes out this swing high, and once price takes out this swing high, each time it breaks it, it's going to stall. Value's going to go down because people are taking profits at those levels. And people are leaving the market. So the value goes down. People are not pushing price up anymore until you see another 3-bar reversal. That's the first thing I want to teach you in the basic lesson is the 3-bar reversal pattern. Because every time you see a 3-bar reversal pattern, that lets you know that price is going to go in a different direction. You never know how high it's going to go. But in this case, if I move this here, let me move this out the way. Once price hit here, it created a second touch of these wicks. This wick is also known as the liquidity area. If it comes back and touches this trend line again, people are going to get out. It might break the trend line and price might reverse, but price will tell you when it's going to reverse. It reversed right here with this 3-bar reversal. With this 3-bar reversal. This is a 3-bar reversal, but it looks different on a different time frame. And let me show you what I mean. Watch, I'm sorry it's taking so long. I promise I'm going to quit here soon. I'm going to mark this area, and I'm going to make it yellow. Okay, watch this area. This is going to turn into 3-bar reversal, but it looks different on a different time frame. So I go down to the 15-minute chart. It doesn't look like a 3-bar reversal. You see the 3-bar reversal now? This bar, well, the next bar should be closed lower. That wick is high. That wick is the next bar, the next 15-minute bar, it may close lower. The 6 to 5-minute chart. Here's a 3-bar reversal. That's really clear. 1, 2, 3. Then it retested that high and rejected, came back down. So they look different on different time frames. So that's why you should be patient. Get familiar with a 3-bar reversal because it has different looks. It just looks different on different time frame. That's another reason why you want to go from different time frames, from one time frame to the next, because you want to check where that 3-bar reversal is. This is a 3-bar reversal. It took out that high, but it was trying to attack that one. It hasn't broke out yet, but it might be going higher. If it breaks out, it's going to break out here, and it's also going to break out here. And guess where it's going to go to? You notice this area right here? If it goes and breaks out there, it's going to eventually attack this fair value gap. Why? Why will it attack that area? We're on the 30-minute time frame. I think I have a 30-minute fair value gap. There it is. It's going to attack that 30-minute time frame because price didn't deliver properly in between these areas. So it's going to go up to at least half of it. That's where you set your target. Or it might continue to go higher and start attacking this high. It's always going to start sweeping liquidity where liquidity's rest. There's money right here. There's money right there. There's money right there. So it's going to go up level by level. Price always moves in waves. So that's it for now. This video's been over 30 minutes. Pause it, rewind it, go over it again, take your time. Don't be in no hurry. It'll come to you. It's going to come by faith and patience. You just have to put in the work. So let's get this money check. Love ya.